Prof,
Yeah, Adeswa.
connected now.
Okay. Let me also
Mm.
make you co-host. Let me
Oh,
make you
okay.
co-host.
Okay.
So you can be admitting now I am while I'm lecturing. Adeswa, I want to mute now so that the sound from my house will not enter the video until the students come.
Prof. Hello, Prof.
Yes, I can see that they are here. I know.
Yes, the students are connected.
I know. I saw him. Good evening, class. And it's time for our lecture today. We'll be discussing a different topic today, which is a continuation, sort of what we discussed the last time. The last time we talked about full costing, absorption costing, and activity-based costing. Right now, I want to share my screen and give us what we'll be learning today. Okay, let me share the screen. Fine. Now that share the screen now, let's see the topic for today. The topic for today is marginal cost. Okay, sorry. Supposed to be marginal costing versus absorption costing. Yes, that was the topic. Marginal costing versus absorption costing. So you'll be asking yourself, what is absorption costing doing here today? Didn't we take absorption costing last time? Yes, we took absorption costing and ABC. We said that both of them are the same kind of treatment when it comes to variable costs. But when it comes to overheads, which are fixed costs, that is where they differ. And so the method of doing absorption costing and that of ABC lies in how they treat overhead. And apart from that, we said that even though marginal costing seemed to be the most reliable of the two, absorption costing continues to gain more ground. And we said that absorption costing and margin and activity-based costing are method of full costing. Today we're going to be looking at marginal costing and absorption costing. So look at the class rules. Although you know the class rules already, but we still need to say it so that for the sake of emphasis, you are to be muted, your audio, you're not to start your video. This is to allow for proper coordination. If you have any question to ask, use the chat button. But I would suggest take a jotter and jot those questions down first, because it's easier to do that than to start chatting. You'll find out that some of these questions may be answered in the course of the lecture, so there may be no need for you to ask the question anymore. Okay? If you have any difficulty, technical difficulty, call that helpline. Then what about using the chat button? You have to be professional when using it. Then you are expected to listen attentively to each lecture instead of writing. But you can jot down just a few points you think is not in the material you want to remember. All questions asked will be attended to by the lecturer at the end of the lectures. Okay? We've talked about the introduction, which is the absorption costing versus activity-based costing. We saw that overhead absorption rate is one fundamental thing that must be calculated when we do absorption costing. And because we are looking at absorption costing in line with marginal costing, that absorption or overhead absorption rate will rear its head. Now, what is marginal costing? Marginal costing is an alternative costing method to absorption costing. So when we say that absorption costing is a full costing method, marginal costing is not a full costing method. So when you hear the word margin, your mind takes you to marginalized. When you say somebody is marginalized, what do we mean? We mean that somebody is being denied certain things. What he has is not complete. So the person is marginalized, denied. So why is this cost being marginalized? What makes it marginalized? This is because it is not a full cost. Something is denied it. And that thing that is missing in marginal costing is the fixed cost. So marginal cost of an item is the variable cost of an item. We said before that full cost is the sum of variable cost and fixed cost. And so absorption costing takes full cost. Marginal cost, you are denied the fixed cost. So marginal cost is the same thing as variable cost. So when we say marginal production cost, now we are channeling it down to production. It means that your direct materials, which are all variable costs, your direct labor, which are variable costs, your direct expenses, which are also variable costs, and any production overhead, all joined together to give you marginal production costs. So all these things, you see the words production here. When you hear direct material, direct labor, direct expenses, these are marginal production costs. So we can as well say that marginal cost of sale and marginal production cost is marginal prime costs. Marginal prime costs. Now, look at marginal cost of sale for a product. Now, it is different from marginal production costs. Marginal production cost is different. Now, look at it here. It includes direct materials, direct labor, direct expenses, direct variable production overhead. So that stops production. Then you see other variable overheads. So we have variable selling and distribution. Now we also see marginal cost of sales for the service is equal to direct materials, direct labor, direct expenses plus direct overhead. So the same thing you see for goods, you see the same for service. It's just that goods you will have opening stock, closing stock. That's the difference. Now, marginal costing and its uses. What are some of the uses of marginal costing? Marginal costing is a method of costing with marginal costs. It's an alternative to absorption costing as a method of costing. In marginal costing, fixed production overheads are not absorbed into the product costs. So you see, you want to find the cost of a product. You don't use the full cost when doing marginal costing method. You only use the marginal cost and charge that to the product. So the fixed cost does not get absorbed into the product. And so your selling price will not include cost. Fixed cost will not be used in determining the selling price. Now, there are several reasons why we use marginal costing. One of that is to measure profit or loss as an alternative to absorption costing. We will be looking at how to measure profit and loss using marginal costing and using absorption costing so that we can see how these two are alternatives. Okay? Now, the second one is to forecast what future profits will be. Yes, because marginal costing does not have the fixed cost element. It is a very useful tool for making forecasts. Then we also use marginal costing to calculate the minimum sales that must be made in order to make a profit. So we use that is called cost volume profit analysis, your CVP analysis. I believe the other lecturer taught you CVP analysis yesterday. And so one of the uses is we use marginal costing to determine our CVP. Look at other uses. It can also be used to provide management information with information for decision making. Now, there is something in marginal costing that makes it very, very, very suitable for decision making. We will get to it. Now, its main uses, however, are for planning, for example, budgeting. Yes, when you are doing your budget, you need marginal costing to help you. We also use it for forecasting. Yes, I said it before here, and decision making. So these are some of the things that we use marginal costing for. So you may be faced with a question in exam, state some of the uses of marginal costing, or some of the uses of marginal costing are the following, except they start giving you a list because your exam is going to be, some part of it will be objective. So be prepared to look at marginal costing in the objective part. Now, what are some of the assumptions we can make in marginal costing? For the purpose of marginal costing, the following assumptions are normally made. One, the first one is every additional unit or output or sale, or every additional unit of activity has the same variable cost as every other unit. In other words, the variable cost per unit is a constant value. Now, what do we mean by that? What we mean is this: every unit you are selling has the same variable cost. So if it takes me 50 naira to make, or let's say, 50 naira to make one small piece of cake as a variable cost, that would mean that the second piece of cake will take 50 naira too. The third piece of cake will take 50 naira. If I'm making 10, you just know that you're going to say 50 naira multiplied by 10 gives you 500. Shows that every additional output or every unit of activity has the same variable cost. So it means that variable cost per unit is fixed. It sounds confusing. Variable cost is fixed. Maybe later you will learn that fixed cost varies. Now, variable cost in per unit terms is fixed, is constant. Now look at the second assumption. Fixed costs are costs that remain the same in total. regardless of how many units are sold. Now, from this, it means that fixed cost per unit varies, while variable cost per unit is fixed. So you can see that, okay, let me illustrate how fixed cost per unit varies. Let's say that my rent for my shop is 100,000 naira. That's good. That is a fixed cost. So in total terms, fixed cost is 100,000. Now I decided to do 100,000 loaves of bread, and I want to share the fixed cost into it. If I divide it by 100,000 loaves of bread, each of them gets 1 naira each. Now what happened if I decided to do only 50,000 and I want to share the fixed cost in the units? They get twice 2 naira per unit. So you see, when there is varying activity, fixed cost per unit is varied. But in total terms, fixed cost is fixed. That is where it gets its name, fixed cost. In total terms, fixed cost is fixed. But in per unit, fixed cost may vary. But variable cost, in total terms, it varies, because if I am making 1 naira for 1 unit and I do 5 units, that's 5 naira. If I'm doing total of 100 units, it's 100,000. So in total terms, variable cost varies, but in per unit term, variable cost is fixed. That's the assumption. Okay? Now, another assumption says costs are either fixed or variable. And we can also get a mixture of fixed and variable costs. So mixed costs, we can separate them by bringing out their fixed elements and their variable elements. There is a technique, not even one, more than one technique that we can use to extract the fixed costs from the variable costs. One of those techniques is called the high or low method, which you will learn soon. And the other one is the regression analysis method. So when we see that a cost is fixed, it's not fixed, neither is it variable, you can use those methods to extract them. So how will you know that a cost is not fixed and it is not variable? How do you know that a cost is fixed, first of all? If it is fixed in period 1, you will see the same amount in period 2, perhaps the same amount in period 3, you know it's fixed. But when you see different amounts, how do you know it varies? It varies. All you need to do is that total cost divided by the total number of units. If you get a figure, test the second one. If you get the same figure, you know the variable cost, that's a variable cost, because variable cost per unit is a constant. But if you get a different variable cost per unit the first month, from the second month, you know that this is also not variable, but a mixed cost. Now we said marginal cost of an item is therefore the extra cost that will be incurred by making and selling one extra unit of the item. Therefore, marginal costing is particularly important for decision making as it focuses on what changes as a result of a decision. So there are certain decision parameters, and we will now say, okay, what if I change this parameter? What will be the result? What will be the impact on my decision? Okay, if this parameter now changes, how does it affect the results? How does it affect my decision? All this is made possible by marginal costing. Why is it possible? Because of the key ingredients, which is called contribution. So contribution is a key concept in marginal costing. Henceforth, know that you'll be hearing the word contribution in our lectures every given time, because PM or management accounting is all about studying costs. And marginal costing plays a major role in that study. And so because of that, contribution will be a key factor. What is contribution? Contribution is simply your sales, total sales, minus your total variable cost. We can say your total sales minus your total marginal costs. Now, we can either do this in total terms or we can do it in per unit terms. So contribution per unit is equal to sales per unit, which we call selling price, minus variable cost per unit, which will give you contribution per unit. Fixed costs are a constant total amount in each period. We said that before. So to make a profit, an organization must first make enough contribution to cover its fixed cost. So what do we mean? Fixed costs are total is fixed in total terms. And so for you to make a profit, you must sell enough quantity of goods to make enough contribution that will be greater than your fixed cost. So if you make 5 sales of 5 loaves of bread, and you have a fixed cost of 2,000 naira, and what you just sold is only 500 naira, that means your contribution might become maybe 250. So you have not made enough to cover the fixed cost. So what you need to do is to increase the quantity of sales you make. And as you keep increasing, you keep adding your marginal costing to it. And you are getting a contribution that is rising until it gets to a point where your contribution will not be higher than your fixed cost. Then you make a profit. So this means that total contribution minus fixed costs. Of course, when we say fixed costs, we mean total fixed costs will give you profit. Now, when fixed costs have been covered, any additional contribution that you make adds directly to the profit. Now, let's see it this way. Let's say your fixed cost is 10,000 naira, and you made a contribution now of 10,000 naira. Your profit is 0. This means because you have efficiently covered your fixed costs. Now let's assume that you made additional 1,000 naira contribution. Now as you are adding 1,000 naira to your contribution to increase it by 1,000, your profit is also being increased by 1,000. So that's what we mean that once your fixed costs have been covered, any additional contribution is directly adding to profits. If total contribution fails to cover fixed costs, then there is a loss. So that means you have 10,000 naira, your contribution is 8,000 naira, you are making a loss. Loss of how much? Loss of 2,000 naira. So that's the concept of contribution. Contribution is sales minus variable cost. So that should ring into your ear. Sales minus variable cost. Now look at this other formula again. Total contribution minus fixed cost will give you total profit. If we make total contribution subject of formula, that means if it's standing alone, this fixed cost that is nearer to it will go to where the profit is. It's carrying a minus sign, so it will go to the other side to become a plus sign. So it means total contribution is equal to profit plus fixed costs. So these are the two formulas that contribution has. Total contribution is equals to sales minus variable cost. Total contribution equals to profit plus fixed cost. We are going to be playing with these two formulas a whole lot in this course. Now we've seen the major ingredients in marginal costing. So if you are doing marginal costing and you have not done contribution, then you have not done it. Because when we say marginal contribution, we are asking you, what is the contribution? So contribution is more important than profit. Contribution is more important than profit. This is because contribution will help you to make decisions. Contribution will help you to do forecasting and others. Now, let's go into reporting profits with marginal costing. How do we report profits with marginal costing? Now, total contribution minus fixed cost. That's what we mentioned here. Profit is measured by comparing revenue to the cost of goods sold in the period, and then deducting other expenses. That is how we calculate profit normally. So we say revenue minus cost of sales, that will give you gross profit normal. Then we deduct other expenses, will give you profit. Now, the cost of goods sold is the total cost of all production costs in the period, and it's adjusted for inventory movement. What we mean by adjusted for inventory movement is you have opening stock, you adjust your closing stock, because not everything that you move into your factory was moved out. So some of them remain unsold at the end of the period. And so we say adjustment for inventory movement. So the cost of goods sold will include your opening stock, your purchases, and your closing stock. So that's how you get the adjustment for inventory movement. Now, in marginal costing system, there is nothing like cost of goods sold, nor gross profit. That is not the style of marginal costing. That is not the style of management accountants. So that is why we say profit is not as important as contribution. In marginal costing system, the opening and closing inventory is not measured at full cost, but measured at marginal costs. Now, how do we measure it at marginal cost? The cost per unit will only include the variable cost of production, which is the direct material, the direct labor, the direct expenses, and when you get to variable production overhead, when you get to production overhead, just take only the variable part, leave the fixed part. So that will give you your kind of marginal cost of sales, not the real cost of sales anyway. We'll call that one marginal cost of sales. Now, when measuring profits using marginal costing, it is usually important that you identify your contribution and subtract fixed cost. So let's look at it side by side, because we are saying marginal costing versus absorption costing. Marginal costing, the important thing here is contribution. For absorption costing, instead of contribution, you get gross profits. So how do you get your contribution? Sales minus your variable cost. How did you get gross profit? Your sales minus your cost of sales. Then, how they get the remaining profit is different. Why? For marginal costing, it is contribution minus the fixed cost. The fixed cost can include production fixed cost, and selling and distribution fixed costs. Even the variable cost that is used to arrive at the contribution can also have selling and distribution variable cost. It goes into variable cost. But that of absorption costing, it is strictly production, gives you gross profit. Gross profit, strictly non-production fixed costs. All right. Now let's look at an example of how a profit statement can be made using marginal costing. Now this is an example, I call it example MC01. MC is the short form of marginal costing. Now look at these sales. It's just an arbitrary figure, an assumption. All these figures are assumptions. Your sales is 360,000 naira. Now your direct costs. What are these direct costs? These are your direct material, your direct labor, your direct expenses. I can call them prime costs. They all amount to 105. Then you have your variable production overhead is 15,000. You add it there. Then you see that there is variable sales and distribution costs, which is 10,000. So what you are doing is, after your sales, the next thing you are trying to do is to extract all your variable costs wherever they can be found. So all your total variable costs, you can see here is total marginal cost. We say it's variable cost. When you add your 105 plus 15 plus 10, you are getting 130. So we say contribution is sales minus variable cost. So we do your 360 sales up there minus your marginal cost of 130, you get 230 as your total contribution. Then, assuming you have a fixed cost of 150, you bring it under there, you deduct it to get a profit of 80,000. Yes, when you do assumption costing, you might still derive 80,000 naira as your profit, but the way and layout in which you do your absorption costing and marginal costing are different, even though you get the same final figure. This is because there are certain things that are more important than that final figure. That is why the layout changed. Now let's look at total contribution and contribution per unit. In marginal costing, it's assumed that variable cost per unit of a product or per unit of a service is constant. I keep saying that. If the selling price per unit is also constant, it means that the contribution A from selling 1 unit of a product is the same. So when I say, okay, I want to buy a phone, maybe a particular brand of phone, the selling price does not change. The variable cost for that one phone does not change. That will mean that the contribution per unit does not change also. It also means that contribution per unit is a variable item. It also means too that sales per unit or selling price is a variable item. It means that as you increase the quantity, the figure increases. So total contribution can be calculated as follows: units of sales multiplied by contribution per unit. Now look at example 2. A company manufactures and sells 2 products, A and B. Product A has a variable cost of 6 naira and sells for 10 naira. And product B has a variable cost of 8 naira and sells for 15 naira. During the period, 20,000 units of product A and 30,000 units of product B were sold. Fixed costs were 260,000 naira required. What is the profit or loss for the period? Now look at the way we do it. Okay, we look at the quantity sold For product A is 20,000. For product B is 30,000. In total, you don't put anything there. Okay, the selling price of 10 naira. The other one is 15 naira. Variable costs, 6 naira from the question, 8 naira. So when you say selling price per unit minus variable cost per unit to give you contribution per unit. So that's 4 naira. The other one is 7 naira. Now, what is your total contribution? All you need to do is your total contribution, we said, is your unit of sale, which is 2,000 multiplied by your contribution per unit, 4 naira. That gives you 80,000 naira. And when we do the second one, we say is 30,000 units multiplied by 7 naira will give you 210,000 naira. When you add the two of them, 80,000 plus 210, you get 290. So that is where we now use our totals because we want to deal with fixed costs. We don't deal with fixed costs in per unit. We deal in fixed costs in total terms. So we have to get the total contribution. Now, total contribution of 290 minus the total fixed cost of 260 gives you 30,000 naira profit. So that way you have shown that there is a profit of 30,000 naira. Now, let's look at marginal costing income statement with opening and closing inventory. Let's see what we can learn when we use marginal costing in profit statement and there is an opening and closing inventory. Now, in absorption costing, the production cost of sales is normally calculated as opening stock, add production costs during the period incurred. Normally, you either say add purchases or add production costs. Then you less your closing inventory. That will give you your production cost of sales. This same principle will be applied in marginal costing. So the variable production cost of sales is calculated as opening inventory plus variable production costs less closing inventory. And so suffice it to say that the opening inventory must be variable, the closing inventory must be variable. Everything there should be variable. When marginal costing is used, inventory is usually valued at its marginal cost of production, or we can call it variable production cost, without absorbing any fixed production overheads. All right. Now, if an income statement is prepared using marginal costing, this is the kind of thing you might see. Now, if you look at this question here, the sales here is 440,000 naira. Yeah, that's the revenue. Now, your opening inventory, this one is at variable cost. It's an assumed figure, 5,000 naira. Then your variable production costs. These are the items that make up the variable production cost. We have your direct material, 60,000. Your direct labor, 30,000. Then you have your variable production overheads, 15,000. So you now do a straight addition, 5 plus 60 plus 30 plus 15, you have 110,000. So that's 110,000. You now say less closing stock. Sorry, the 80,000, the 8,000 you see in that other column should have been part of this first column. So you will now less your closing inventory at variable production costs. So you say less 8,000 naira. So it will give you your variable cost of production or variable production cost of sales. So 110 minus 8,000 will give you 102. So now this is your variable costs of sales. Now that you have done with production, let's go to non-production. We now have variable selling and distribution expenses. We have it as 18,000. When you add them up together, what you are getting is your variable costs, which is 120. So when you say 440 minus 120, your contribution is going to give you 330. Don't get it twisted. This 8,000 is not among the second. It's among the first column. So sorry for that. So your contribution is 320. Now let's bring out our fixed costs. Our fixed costs, all these items here, sorry, I don't know how they shifted from 120 down to 280, no, down to 90 are all on the first line. So production fixed cost is 120, selling and admin costs is usually 100% fixed costs. All admin costs are usually 100% fixed costs. So if you notice, when we are doing variable costs, we didn't see variable admin costs, but you saw variable production costs. Now you are seeing fixed production costs. We saw variable selling and distribution costs. Now you are seeing fixed selling and distribution costs. But when it comes to admin, every admin cost you see is a fixed cost. So when you add your 120 to 70 to 90, all you get is 280. So when you add the 280 become your total fixed cost, which is brought to the second column. So we now say 320 minus 280 gives us 40,000 as our profits. So that is how we do over marginal costing profit statement. Now look at how we contrast it with the absorption costing. Now, if an income statement is prepared using absorption costing, the opening and closing inventory might be shown as follows. Look at it here. Sales assumed to be 430. Now look at the opening inventory. Now notice that this is saying at full production cost. The other one, in marginal costing, is at marginal cost. So you now bring your full production cost, which includes both the fixed costs and variable costs, as long as these are production costs. So variable cost, fixed costs are there, direct material, direct labor, and your production overhead absorbed. Now, when you say production overhead absorbed, you are using your overhead absorption rates. Remember from last class, that is how you treat the production overhead or fixed cost absorbed. So when you add everything here, 8,000 naira opening stock plus all these other ones, you get 198. Then of course, you have to find your closing inventory. Your closing inventory will be at full cost. We assume it to be 14,000. So when we remove 14,000 from 198, all we have is 184, which moves to the other side. Yes, full production cost of sales is 184,000. So you see, it is saying full production costs of sales. That means variable cost is there, fixed cost is there. Fine. Now you have 430 minus 184 equals to 246,000. Now, look at another thing you need to do. You need to find whether you have over-absorbed or under-absorbed. Now, you provided 100,000 in the calculation of production overhead, which I told you before we got our cost of sales. we said we use our overhead absorption rate to get 100,000 naira, which is what is brought down here. This 100,000 here, this 100,000 here is gotten by overhead absorption rate, which is what is the same 100,000 here. Yeah. Now, this 95,000 is the actual overhead you spent. This is the actual overhead you spent. Now, that will mean that when you less this one, this 95,000 from 100,000, you have a balance of 5,000 naira. This 5,000 naira is over absorbed. So this 5,000 naira is over absorbed. So we told you over absorption is a positive number whereby your expected is higher than the actuals. So now what do you do to this over absorption? You now add it to this here, to this figure here, gives you 251. When you get your 251,000, you now say this 251,000, you less your selling and admin costs and selling, distribution and admin costs. Yes. Now all of these admin costs are fixed. We know that. Part of this selling and distribution costs are fixed, part are variable. But as long as admin and S&D are not production, they don't go into here. So we get 178,000 naira. Our profit becomes 73,000 naira. So can you see the difference in method in what we calculated using marginal costing and how we calculated using absorption costing? Now, let's do an example. They say the following example illustrates the calculation of cost profit and absorption cost profit. The other one is marginal cost profit and absorption cost profit. So let's illustrate it with this now again. Makurdi Manufacturing makes and sells a single product. Now look at the selling price, 150 per unit. The variable cost is now divided. Now we see direct material is 35 naira, direct labor is 25 naira. Then your variable production overhead, of course, we know it has been done using overhead absorption rates. Then your marginal costs, okay, sorry, your variable production overhead was not done using overhead absorption rate because this is marginal costing. It's in absorption costing, you use OAR. Now your marginal cost per unit is 70 naira. Now can you see here that this is used in inventory valuation? What we mean is that it is this 70 naira that will be used to value our stock, opening stock, closing stock, based on marginal costing. So we're going to be using 70 naira each time. How did we get this 70 naira? It's a calculation of the sum of direct material, direct labor, and variable production overhead. All right? We were told that fixed production budget overhead, budgeted fixed production overhead is 110,000 naira per month. Now, this is fixed because every month you keep paying 110,000 naira. So look at the following data for July and August. You see that the fixed cost is still there, 110 in 2 months. So that is how you know that the cost is fixed. When you see 110 here, 110 there, it's fixed. Now look at the production. You can find out that the productions are different. We have 2,000 units in July, 2,500 in August. And the sales are different. 1,500 in July, 3,000 in August. They now give us something. They said there was no opening inventory in July. What this means is that opening inventory is 0. Also, there is no closing inventory in August. This also can be seen here. How do we know that there is no closing inventory in August? Look at this production of 2000 here. This 2000 here. It is the same 2000 here. Now, add it to this 25. It gives you 4005. So that is what is produced for the 2 months combined. Now look at the sales. This 15 here is the same one here. Add it to 3000 for August. It means that he also sold a total of 4500 during that 2 months period. It shows you that there is no closing stock in August. So required, show the profit statement for each month using marginal costing method. So we're going to show the profit for each month. There are 2 ways we can use. We can do the columnar method, which I decide to use because of space and book, but you can also do them one by one. So I'll be explaining them one by one, but we can do them in columnar form. Now, after setting up this thing like this, let's treat the July first. Let's treat the July. So let me use this for my, let me use this for the question. Okay, sorry. Let me get this for, sorry. Let me get what we use for solution. Okay, so this is our solution. So we'll be comparing the question and the solution. So looking at the solution, how did we get our revenue of 225,000? So this is what we did here. We were told that, let me bring out my calculator. We were told that our selling price is 150. 150. And how many units was sold in the month of July? 2,000 units. 1,500 units was sold. So I will just multiply it by 1,500. What do I have? I have my 225,000. So that is how we got our 225,000 naira here. So let's go to our variable costs. We now say we are going to divide it into production costs. And now we are looking at production costs. Let's start with the opening stock. According to the question, there was no opening stock in July. So that's why we are seeing a 0 here. Now, look at the purchases or the production costs. Production cost here, we can say our purchases or production costs. This is this 2,000 units here. So 2,000 units was produced. Okay, look at the production data here. We have direct material 35 naira for 1 unit, direct labor, variable production overhead. When you add them, you have your 70 naira. So all I will now say is we produce 2,000. So we say 70 naira multiplied by 2,000 units. It gives me 140. So 140,000 here is our production or say purchases. Now our closing stock, how did we get this 35,000? What do we need to do? Our closing stock is how many? We look at it that you produce 2,000 units, that is what you produced, and you sold 1,500 units. You are left with 500 units unsold. How do you evaluate it? The question says 70 naira used in inventory valuation. So you will say 500 multiplied by 70, and that gives you your 35,000. So the 35,000 we got here is our closing stock. So we're supposed to less closing stock from the production cost. So we say 140 minus 35,000. What we get is 105. As this 105 here. We were not given any selling and distribution costs. So if we still less it from that or add it to that, you're still getting 105, which is your variable cost here, which is brought to the other side. So when we say our contribution will simply be 225,000 minus 105,000. That will simply give us 120. So 120 here is our contribution. Now, the question told us that the fixed cost is 110,000. So all we need to do now is this 120 we've gotten as contribution minus 110,000. It gives us 10,000 naira profit. So that's the profit we got here. Then we go to the next month, which is August. Our sales revenue from the question, we were told that sales revenue is 150. And how many did they sell? They sell 3,000 units. So I simply say 150 multiplied by 3,000 units gives me 450,000, which is what we have here. Now we go to the variable cost, production cost. Our opening stock is the same as the closing stock of the last period. So the last period's closing stock moves to this place here as the opening stock. Now, purchases or production. What do we have here? How did we get this 175? We were told that production were 2,500 units. So I will say 2,500 units multiplied by 70 naira. 70 naira. That will give me 175. 175 got here. So there was no closing stock. How did we know before? We said before that they produced in July 2,000 units. They sold 1,500 units. Closing stock in July was 500. They now produced 2,500. That means 3,000 was available before the sale. They now sold 3,000. Closing stock is 0. So closing stock here is 0. So what we do now, we add all of this together. We say 35,000 plus 175,000 plus 110,000, 420. Sorry, it's a mistake. It's supposed to be 420. 420. Sorry, it's my mistake. Sorry, it's my mistake. 35,000 plus 175,000 will give you 210. So you're adding them here to get this marginal cost of sales, 210,000. Yes, it's correct. Now, we're not giving any selling and distribution expenses in the question. So when we say 210 plus 0, we are still getting our 210 here. So our 210 is our variable cost. So what we'll do, 450,000 minus 210. That gives you 240 as your contribution. So when we take away our fixed costs, we are left with 130. And that's your marginal profit statement for July and August. This is the marginal profit statement. Okay, so let's go and see another example. Here, this is another example. Example 0.6. We are told we are given the same data, selling price, direct material, variable cost, and they said 70 naira, the same data. They now give you fixed overhead per unit. And then that said, see below how they got this 50 naira. So we're going to look at how this 50 naira was gotten later. Now, this is the total cost or total absorption cost per unit. And they said something here, used in inventory valuation. So that means when you are doing your absorption costing, you are using the full cost to value your inventory. While doing marginal costing, you're only using your variable cost to evaluate your inventory. So 70 plus 50 gives you 120. So now let's see how the analysis, we'll see the analysis later. Normal production is 2,200 units per month. So this is what they normally produce. Now look at the budgeted fixed production overhead. Like we said before in that other question, is 110,000 naira per month. No problem. 110,000 naira per month. So your fixed overhead cost per unit will simply be this 110 divided by this 2,200. And that was how this 50 naira was gotten. That was used here. 50 naira used here. So that's how it's gotten. So we're not given the same data. We are told this same language that we saw in marginal costing. Required, show the profit statement for each month using absorption costing method. So you will now see the difference that occurs when we use absorption costing method. So we'll be navigating with the question and answer. So now let's look at the absorption costing method. You understand how we got our 225 revenue multiplied by the selling price and quantity multiplied by the selling price per unit. Now, our opening stock for July, you remember we have no opening stock, 0. Our purchases is 140 as against what we did before. 140. Yeah, it's the same 140. It's the same 140 that we used before. So how did you get the 140? $35, 25, 10. This is 70. So this 70 multiplied by how many quantities was produced? 2,000 multiplied by 2,000 gives us a 140. So the same thing we did in the other one, in the previous example, marginal cost, we got the same 140. Now, your fixed overhead absorbed using the OA arrow is 110. So we've done it here, 15 naira per unit. So what are you going to do? You will not say 50 naira multiplied by 2,000 units, because you will say 2,000 units is what is produced. If you do that, you'll be getting 110. Yes, that is the actual overhead incurred. That's the actual. But you should always add your overhead over absorption. So what it means is that you budgeted 110,000, you incurred 100,000. The remaining 10,000 must always be added to the 100,000, which is what is incurred. So you find out that whatever you incur, the actual, add your over-absorbed expenses or your over-absorbed fixed cost to it. So you always be getting this 110. So that's why we see this 110 here being featured. It's also featured here in the sense that I'll come back to August, how we got it there. Now look at your closing stock. How did we get this 60,000 as your closing stock? Mind you, we produced 2,000 and we sold 500 remaining. And we are told that we're going to use 120 as our valuing cost. So we say multiply by 120. That's how we got the 60,000 we used here. And mind you, this 60,000, as soon as you put it here, just take it straight and put it here so that you will not have stories. So what you do now is 140,000 plus 110 minus 60,000 gives you 190. So 190 becomes your cost of sales. So 140 is opening stock, 0 is opening stock, 140 is production variable overhead, the 110 is fixed production overhead, the 60 is closing stock, gives you 190. So what do? You say 225 minus 190, that gives you 35. So 35 is your gross profit. And because there is no selling and distribution, your main profit is 35. Now let's go to the absorption costing for August. We know that our revenue was 150 naira and they sold 3,000. And that gives us 4.5, 450. Now we said our opening stock here is the closing stock of last month. That's fine. This 175 is as a result of the 2,500 we produced multiplied by 17 naira production overhead. That's the 175. Then your 110,000 keeps coming here. So how do we handle that? We say that 50 naira multiplied by how many production units? Multiplied by 25, supposed to give you 125. 125 is what you actually incurred. But what was that you budgeted? What you budgeted is 110,000 minus 125. That means 15,000 was under recovered. So what you will now do is, if you are putting your 125, you always less it by 15,000 to give you the 111,000. So what it means is that fixed costs is always the budgeted. Each time you are doing fixed costs, you will be using the budgeted per month and not the actual when you are doing, excuse me, this kind of data because of over and under absorption. So that's it here. So let's continue our calculation. 60,000 plus 175 plus 110,000 minus 0 will give you 345 here. And we know that's your cost of sales. So when we less it from 450 minus 345, what we have is 105, which is the gross profit, and which is also the net profit. So we've seen how we can use absorption costing and marginal costing in profit statement. Now look at the difference between, okay, let me use here. The difference between marginal costing and absorption costing. The profit for an accounting period calculated with marginal costing is different from what is being used, from what we calculate when we use absorption costing. The difference is entirely due to differences in inventory valuation. If you look at it here, the only difference here was how we value our expenses. Okay, let me open the two here so that we can be seeing them side by side. Let's look at the marginal costs. Now, can you see that the difference is because of this closing stock here that entered opening stock here, 35, and here is 60, 60. So every other thing is the same. 140, 105 is there. Okay, sorry, 140 is there, still the same 140. This 105 is a calculated figure. So all the inputted figure, 140 is the same, 75 is the same, 225 is the same, 450 is the same. So all these inputted figures are the same. The only difference is the valuing of stock. That is what caused the difference. Now, the main difference between absorption costing and marginal costing is that in absorption costing, inventory costs include a share of fixed production overhead costs. So the fixed cost that has production element goes to absorption costing to get the cost of goods sold. The opening inventory contains fixed production overhead that was incurred last period. Opening inventory is written off against profit in the current period. Therefore, part of the previous profit costs are written off in the current period. The closing inventory contains fixed production overhead that was incurred in this period. Therefore, this amount is not written off in the current period income statement, but carried forward to the next accounting period. So you can see the differences there. So suffice it to say, let me just give you one small technique or one small thing you should know. Each time you are doing something that has to do with inventory movement, just know that if your opening stock is higher, maybe you are comparing two information. If an opening stock is higher from one period to another period, or if you have a higher opening stock, that means your cost of goods sold will be high, because opening stock is part of the things that that increases your cost of goods. And if your opening stock is high, your cost of goods will be high, your gross profit will be low. And so your profit will be low. So if your opening stock is low, your profit will be high because your cost of goods will be low. When you less it from the sales, you will get a higher profit. Now look at closing stock. Closing stock is just the opposite. This is because closing stock is being deducted from production cost to get cost of sales. So it's as good as saying your closing stock is increasing your sales revenue, so to speak. But the impact is that it is reducing your cost of sales. So it means that the higher closing stock you have, the lower your cost of sales, because that closing stock will be deducted. The lower your cost of sales. And when you lower your cost of sales, your profits will be higher. So let's look at the relationship again. A higher, it can be an OBJ question. A higher opening stock increases cost of sales. So the higher the opening stock, the higher your cost of sales. The higher your opening stock, the lower your profits. Then, looking at closing stock, the higher your closing stock, the lower your cost of sales. The higher your closing stock, the higher your profits. So this is something that you should also know. Now look at the advantages and disadvantages of marginal costing and absorption costing. Advantages of absorption costing includes inventory values, include an element of fixed production overhead. This is consistent with what is required in financial accounting. So you cannot be selling a product and you want to value the cost of the product and you say, no, don't add the fixed cost. No, don't add the fixed cost. So you just want to value only the opening stock and you don't want to include the fixed stock. You want to include only variable cost. No, you will not have a good, your figures will not be that complete from the financial point of view. Now, calculating under/over absorption of overhead may be useful in controlling fixed costs. So you see, when you have over absorption of costs, you know that you are taking too much in your budget. It's a way to control it. Now, by calculating the full cost of sales for a product and comparing it with selling price, it should be possible to identify which products are profitable and which one is in a loss-making position. Now look at the disadvantage. Absorption costing is more complex than marginal costing. Absorption costing does not provide information that is useful for decision making. Now, when you'll be entering decision making, you will know why. Now look at the marginal costing advantages. It is easy to account for fixed overhead using marginal cost, but it's not easy for absorption cost because the production cost contains elements of fixed cost, elements of variable cost. The selling and distribution cost contains elements of fixed, elements of variable. So you cannot account for fixed cost easily, but in marginal costing, you account for it. So what you should be doing is the advantages of marginal cost is a disadvantage for absorption costs. The disadvantage of absorption cost is an advantage for marginal cost. There is no under or over absorption of overheads with marginal costing, and therefore there is no need to adjust the income statement. And marginal costing provides useful information for decision making. contribution per unit is constant, and unlike profit per unit, which varies with the level of activity. Now look at some of the disadvantages. Marginal costing does not value inventory in accordance with the requirements of financial reporting. Normally, you are supposed to value your inventory, opening and closing stock with full cost. But marginal costing say no, let's use marginal cost. So it is not too good. Now, marginal costing can be used to measure contribution per unit of product or total contribution earned by a product. But this is not sufficient to decide whether the product is profitable enough. So yes, you know that you can get contribution, yes, but we need to know, are we making profit? Even if contribution is far important, you still need to ask, are we making profit? So your contribution has to be big enough to cover your expenses. So we've come to the end of the course content. Let's look at what we've covered today. We have explained the concept of marginal costing. Yes, we said the marginal costing is the alternative to absorption costing, where the fixed cost is marginalized, is left out. We only use the variable costs. And we said that we've calculated the marginal cost of an item from a given data. Yes, we did that severally. We explained how marginal costs and the concept of contribution are important in decision. We said contribution is important. And we gave two formulas for contribution. The first one, sales or sales price minus variable costs, either in total or in per unit. It will give you contribution either per unit or in total. Then we said total contribution is equals to your total profit plus your total fixed costs. We also describe absorption costing, giving some examples. We also calculated the absorption cost of an item from a given data. Then we compared our marginal costing with an absorption costing. We saw them side by side, how they are used in financial statements, how they can be used in profit statement to see how profit is being derived. We also saw the difference between the profit gotten from absorption costing and that of our marginal costing, caused by the way inventory are being valued. I also told you that the higher the closing stock, the higher your profit, the lower your cost of sales. The higher your opening stock, the higher your cost of sales, the lower your profit. Take note of these things and you won't go wrong. Thank you so much. Let me see if you have any question here. Let me see if you have a question here because this is question time. You can see one chat here. Okay, that's just from the admin. No question. If you have any question, feel free to chat me up and we'll get it done. Thank you so much. I hope you are going to review all we've learned and get back to me. Have a good night rest.
Prof.